Hi, everyone. Welcome to the webinar today. My name is Alexandra Alvarado. I'm the Director of Marketing and Education at the American Apartment Owners Association, and we are so glad that you can join us today. We are going to be talking about a very exciting investment strategy that I think will be really a great fit for a lot of you on the call today, especially those of you that are looking into doing a 1031 exchange anytime soon. But even if you're not, it's still an interesting option. And we have with us today Steve Haskell. He is the VP of Cove Capital, and he's going to be teaching us quite a bit. But before we get started, I did want to just let you know that this whole thing is being recorded. So I am going to email it to you tomorrow, and we are going to have a time for questions after Steve is done, around 60 minutes. And then we'll stay later if you have a lot of questions. We'll see. Put them in the question box, though, not the chat, so that we don't miss them there. And I'll tell you a little bit here about Steve and his background. Give me just a second. Looks like it's not popping up. Where'd it go?
I can take it if you want.
Yeah, Steve, it's not popping up for me. I think it might be a Zoom thing. I'll let you introduce
yourself.
yourself.
Happens all the time. Yeah, I'm sure it'll happen again to me today too. So my name is Steve Haskell. I'm Senior Vice President. I'm actually with a company called DST Properties, which is a specialist and advisor in the Delaware Statutory Trust. Our sister company is called Cove Capital, and that's who is sponsoring today's education seminar and who I'm representing. And we, Cove Capital is one of many groups that we represent at DST Properties. And they specialize in 1031 exchange investment vehicles. And this is called the Delaware Statutory Trust. And it's basically a vehicle in which we take investment graded property and we put it in a trust that qualifies for 1031 exchange. I started doing this about 5 years ago is when I jumped on board with DST Properties and Investments. And before that, I spent the better part of a decade in the United States Air Force as an officer in the special operations community. And and since then, I think we started with about, I think I was number 5 in our company. And now between the companies, I think we're north of 60 and we're hiring every day. So things are growing fast. Delaware Statutory Trust properties continue to gain in popularity, especially as the baby boomers are aging out of property management, don't want to deal with the headaches anymore. And a lot of people tend to be getting out of the coasts right now and trying to find areas with a little more growth, a little more income, and want something that where they can diversify and so forth. So I feel really grateful to be able to provide that value to our investors. And I feel really grateful to folks like you, Alexandra, that allow us to sponsor your events and spread the word about the value that we have to offer. So yeah, back over to you. Should I just jump right into it, or?
Yeah, go ahead. Yeah. Thank you so much for coming, and I'll let you take it away, and I'll be back at the end for questions.
Okay. Alexandra, I'm going to switch over now to a screen share. Make sure that it is successful, because sometimes, the gremlins get in there and things don't work. Let me know when you can see my screen.
I can see it. Looks great.
All right. Beautiful. Thank you. All right, ladies and gentlemen, thank you for joining our webinar today. I'll be representing Cove Capital Investments. And so before we get started, I'm going to go over some risks and disclosures, because these are actually private securities and only certain people are able to invest in these. So first of all, you have to be an accredited investor, meaning having a net worth of at least $1 million, or having income of $200,000 a year, or if you're married, $300,000 a year, or if you have an entity, meaning an LLC or a trust that has a total of $5 million of assets. Okay, so this is just education purposes. I'm not pitching any deals, okay? So you're not going to see any live opportunities. This is just purely education. And each live opportunity does come with a private placement memorandum. So make sure you read that, review it with your CPA, because we cannot provide legal advice, okay? So please consult your tax advisor, CPA, for anything that has to do with your tax consequences pertaining to 1031 exchanges. All right, and there are material risks in DSTs. So everything I'm going to go over is real estate, and there's risk that comes to involved with real estate. So be aware of that. And let's see here. I'm already getting chats. Here we go. All right, perfect. So right. So now we're moving on here. Diversification does not guarantee that there's no risk, but it does benefit and mitigate risk. Okay, long story short, there's no guarantees in any of this. All right. We'd like to have conversations with our clients, long, in-depth conversations leading up to their exchange, because we want to very much to understand your situation before you do a 1031 exchange, because there are risks. And our job is to point out those risks so you can make the best decision for you and your family. All right. Now, with all that out of the way, let's get started. I'm going to break this presentation up, if I can get through these slides here, into parts. The first part is going to be just a 1031 exchange. I'm sure a lot of people on this call know what a 1031 exchange is, but we want to get everyone on the same playing field so everyone has a good reference point. Once I talk about 1031 exchange, I'm going to talk about a little bit about DSTs and what they are, then about Cove Capital. Now, there's lots of companies that put together the Delaware Statutory Trust properties. Okay, they make them, and then we work at Cove Properties with somewhere between 25 and 35 of those different real estate companies that syndicate and put together these investment opportunities. However, Cove Capital is a little unique in the sense that they focus exclusively on debt-free DSTs. So DST properties with no mortgages on them. And I'm going to talk a little bit about the risks of DSTs and a little bit about the benefits of staying debt-free for those of you that may have paid off your mortgage already and don't want to pile on any more debt, specifically at this stage in the real estate cycle. Okay. A lot of people are saying that we're at the potentially at the height, maybe on the back end of the peak of the real estate market. When you're in a deflationary cycle, it may not be a good idea for you to be piling on debt at this point. Okay, so this is an opportunity to mitigate risk by staying debt free. And that's what we're going to get into a little bit today. All right, now 1031s. To start off, no gain or loss shall be recognized on the exchange of a property held for production, use in trade or business or for investment purposes. Okay, that's also called like kind. So what that means is if you sell your property, then buy another property directly after that's used for business or investment purposes, you can defer your taxes. All right, many of you already know that. Now, here's some rules just to make sure we hammer these down before moving on. You must use a qualified intermediary when doing a 1031 exchange. You may also hear it called an accommodator, also called a facilitator. Those are a few different words, mean the same thing. Basically, it's a company that when you sell your property, they must receive the money. And then when you go to buy another property, they release that money to the seller. Rule number one, do not touch the money when you sell your property, okay? I get about 3 terrible calls a year. It's usually about 3. And the worst calls I can get, and you know what they are? It's when a client calls me up and says, hey, Steve, haven't talked to you in a while. Remember back a few months ago when we were talking about doing a 1031 exchange? I said, yeah, what happened to that? I haven't heard from you in a while. And they said, well, I'm ready to exchange with you. Pick me out some DSTs. Let's do it. And I say, okay, well, who's your qualified intermediary? And they say, who's my what? Where's your money right now, sir? It's in my bank account. You owe Uncle Sam 40% of your sales price. The money cannot go in your bank account. It has to go to a qualified intermediary. Set that up first thing when you go into escrow. Moving on. You must reinvest 100% of the net sales proceeds into a replacement property. Okay, many people ask, hey, Steve, I'm selling my property for $500,000. I don't have a loan on it, but I want to pocket $100,000 because I want to do some remodeling and things like that. Is it okay if I take that $400,000, go buy a $500,000 property and take out a little bit of mortgage so I can purchase property of equal or greater value? Unfortunately, no. You're going to pay taxes on $100,000. The IRS states that you have to reinvest the entire proceeds. Okay. Rule number 3. Purchase an equal or greater value in replacement properties as they had in relinquished property. If you sell for $500,000, you have to buy $500,000. But remember, it's net sales proceeds. So if you sell for 500, there's some closing costs. Say it comes out to 490, you have to buy 490. Please speak with your CPA about what that exact number is. Identify replacement properties within 45 days of closing escrow of relinquished property. From the day you close, you have 45 days to pick which properties you're going to buy. Rule number 5, you have 180 days from the time you close escrow to buy that property. So close escrow, 45 days to pick which property you want to buy, 180 days to close on that property. Moving on. All right, here's a little illustration. You see here, close of escrow, 45 days, 180 days. Those days run concurrent from the close of escrow. They're not on top of each other. They're running concurrent. All right, what does like-kind property mean? Some people think when you buy or when you sell a house, a single-family rental, you have to go buy a single-family rental. Not the case. We have clients that sell raw land, buy medical. We have clients that sell an Airbnb single-family rental on the beach, and they go buy a self-storage facility or a combination of all different types of assets. Remember, like-kind means holding property and buying property that's held for business or investment-related purposes. Now, you cannot sell the house that you live in and go buy an investment property, or you cannot sell an investment property and go buy yourself a second home. Not allowed. Okay, what does like-kind property mean? We already went through this, so I'm going to skip it. All right, Delaware statutory trust. Here we go. So that's what we're going to talk about for 1031 exchanges. Hopefully we got everybody on the same page. There's still more that we can go over. Feel free to contact me directly after this presentation, or throw some questions in the question box there, and we can go over them after. But if there's anything that's specific to your situation and not a general question, then it's probably best that we set up a phone call one-on-one after this presentation, just for everybody's sake here. All right, what is a DST property? That's a good place to start, right? So a DST property can be any investment or business property, self-storage, medical, apartment buildings, industrial, triple net leases, FedEx buildings, all kinds of investment property. And those are held title to by a trust. It's called a Delaware statutory trust. Lots of states have them, but for some reason, Delaware got lucky enough that they got blessed by the IRS to qualify for like-kind exchange. So that trust holds title to the property. Okay. And then our investors sell their properties and buy pieces of the trust. Now, is that, as I mentioned, the DST is blessed off by the IRS for 1031 exchanges. And if you want to look for it yourself, you can look at IRC Revenue Ruling 2004-86. Moving on. All right. I already mentioned DSTs use the whole title to real estate. In some ways, a DST is like a limited liability company. So yeah, you might be, a lot of people on this webinar might be familiar with limited liability companies. They might hold their apartment buildings in a LLC, or maybe a trust, or maybe a partnership. A trust is just an entity like any of those. Okay, you can kind of compare it to your family trust. That's probably the most similar entity. But unlike those entities, you cannot 1031 exchange into a fractional ownership of an LLC and 1031 exchange out. Now, you can own title to a DST. You can take ownership in a DST with your LLC. But I cannot go create an LLC and have everyone on this webinar 1031 exchange into the LLC and out of the LLC. That's not okay. But you can do it. If I can go out and create a Delaware statutory trust property, and everyone on this webinar, if they're accredited and it makes sense, can 1031 exchange into that DST and then go out their separate ways once we sell the property. Okay. Now, I'm not offering that. I don't know all of you. So go speak with your CPAs. Please have conversations with, make sure that it's a suitable option for you. But I would love the opportunity to talk to everyone on this webinar. All right, moving on. All right, how does a DST, there's some things in the way. But anyways, with the DST, how does revenue work? How does appreciation work? How's revenue distributed? Okay, how do you make money in DSTs? So DST investors receive their pro rata portion of the potential distributions. Okay, so the trust owns title to a property. That property is producing revenue. If you 1031 exchange own 1%, the revenue comes out of that property and the sponsor peels off 1% to you, the investor, and then maybe 3% to another investor, 8% to another, 0.5% to the other, and then in accordance to their ownership. DST investors receive 100% pro rata portion of any potential appreciation net of sales costs. So that property goes up in value, then the investors receive their pro rata share of that gain. Now, this is unlike a lot of LLCs, partnerships, or private REITs that you may have seen, where there's something called a waterfall on the back end. That waterfall takes place where sponsors participate in the appreciation, in which they may take 40 or 50% of the upside. That is not the case with DSTs. With DSTs, the IRS has required that the investors get to keep 100% of whatever potential appreciation there is in the property, but also loss. So beware, if the property goes down in value, then they get their pro rata share of the loss. And also, if there's amortization of the loan that's on the property, if there is, then there's equity buildup. The DST owners also get to build up their own equity in that investment. Okay. So once a DST is sold, the investors can 1031 exchange into another DST, or they can go into their own property. They can pay taxes or do a combination of all three. All right, so why do people invest in DSTs? Well, the biggest thing is the passive nature. Okay, everything's all set, turnkey. These properties are live. You can close on them in 3 to 5 business days. You don't have to wait for other investors to come in. The sponsor, who's the company that puts together the real estate, they own the DST. They own the trust. Investors are coming in and buying pieces. So if you're the only investor that ever goes into that trust, it's okay. Then you and the sponsor are going to be making revenue as long as that property is producing revenue. And then when the property sells, then you and the sponsor are going to enjoy the appreciation on that or loss. Long story short, though, it's completely managed by the sponsor. There's no decision making on behalf of the investors. Number 2, DST Properties have professional asset and property management in place that goes into the passive nature. Number 3, DSTs allow investors to concentrate further on what really matters: kids, grandkids, travel, other businesses. And then number 4, so these are all kind of the same thing, right? It all goes into, hey, folks are looking to get out of property management. You built up your portfolio over time. You've managed your assets, built up that value, and now you're looking to retire. If that's you, then DSTs may be very much a suitable option to satisfy what you're looking for. Okay, let's walk a little bit through diversification here. So minimums are $100,000 typically for 1031 exchange. So if you have a $500,000 asset, then you could spread that money out through 5 different DSTs potentially. And then you can access all different types of assets. Like it says here, number 3, multifamily, office, industrial, medical, triple net properties. Number 4, which is what we're going to focus on today, all cash, debt-free DSTs, as well as leverage properties. So many of these investments have leverage. Okay, it could be anywhere between 30 to 90% loan to value. Okay, and so if you need a loan, there's the opportunity to invest in DSTs that do have a mortgage on them, and that mortgage is built in and it's non-recourse to the investors. So it's turnkey. You don't have to go out and buy a loan, or apply and sign for a loan. It's all built in. The sponsor signs for the loan, and the property's held as collateral. You could lose your money, but they can't come after you personally. That's also different than some LLCs and tenants in common, where you have to sign and apply for the loan. All right, and also the DSTs allow our investors to diversify their money throughout geographic locations all over the United States. Okay, now tax reporting. What do I get at the end of the year? Do I get a K-1? No, you get a substitute 1099 and you get a grantor letter or tax packet that goes on the Schedule E of your tax return. That's going to look a little bit like maybe the profit and loss statement that your current property management provides to you. You're going to have the total DST profit and loss on one side of the form and your own pro rata on the other. And so you're going to see how much money you made, what their expenses were, how much depreciation is on the property. A lot of folks like that to have basis that they're carrying over. And then you give it to your CPA. Your CPA puts that on your Schedule E, and you're all set to go. So more about the turnkey nature of DSTs. They're prepackaged for investors. So one of the major issues with 1031 exchanges is closing risk, right? You have 45 days to find a replacement property. Okay, you've built up, held a property, managed it, built value over 30 years, and now you're going to sell it, and then you have 45 days to replace it. Good luck. Well, that's a very stressful situation. But with DSTs, we have options that are already closed and turnkey for investors. Very much cuts down on the stress levels, because once you develop a criteria, we've educated you on DSTs. Once you really get into escrow in your 45-day window, at that point, we're just going shopping. You say, we want this one for the portfolio, that one, and this one. We build a sample portfolio that's tailored to what you're looking for. And then we can fill out paperwork, close in 3 to 5 days. Then boom, generating revenue right off the bat. First wire goes out the following month. All right, so we talked about the loan to values, typically 40 to 65%. But at Cove Capital, they're mostly almost 99% of the time, I would say, are all cash, debt-free offerings with no loans. Let's see what it says down here. Cove debt-free offerings are for the most investors that want to, or are for those investors that want to sleep well at night, knowing they don't have a risk of lender foreclosure or other problems that financing can pose on a property. So if your strategy and your goals as an investor is absolute asset preservation, then debt-free is probably the way you should go if you don't have a mortgage you need to replace. And in this conversation, we're going to talk a little bit about why. But first, we already talked about this. Okay, a little more about diversification before we get into that. We talked about all this, all the different types of properties you can get into. We talked about you have to be accredited. These are private securities. You must be an accredited investor. And then a little more about debt-free. Here we go. All right. So this is the page that we're going to dwell on for most of this webinar. So we've had an amazing real estate market, and a lot of our investors have made a lot of money. Typically with DSTs, we advertise that we're searching to hit singles and doubles with DSTs. These are institutional grade real estate, high quality investments. And traditionally, we're not looking to make as much money as a lot of our clients have when they bought their Class C, Class B minus duplexes, fourplexes that they renovated and have just blown up in value in Southern California or the Bay Area. That's not our goals here. But over the last few years, we've seen some really fantastic returns. Now, keep in mind, past performance isn't indicative of future returns, okay? And that's really what in the military we say we want a foot stomp, okay? That's what we want to stress. We see the market kind of turning, okay? Because when you're in that hot market, leverage is your friend. That's how you get rich, is by taking on that leverage and amplifying your upside. And when you take on that leverage, okay, you could potentially buy yourself more real estate and then to get more depreciation and tax efficiency. Okay, that's also a potential benefit. But there's some drawbacks. And if you end up in a deflationary real estate market, then you could put yourself in a very bad position. And at this real estate cycle, At K Properties and Cove Capital, we're focused on positioning our clients for holding power and asset preservation. We are taking a very conservative approach over the next couple of years. And one of the ways we do that is by not taking on any more debt than we absolutely have to. And so a lot of our clients remember the last day that they wrote a check to the bank. They are mortgage free. They remember they're done. Bank of America, goodbye. We now own our asset free and clear. So they come to us and they say, hey, I want to stay debt free. That's actually, in fact, why Dwight K started doing debt-free properties. So Dwight K started right at the recession of 2008, and he saw a lot of pain from a lot of people losing their properties, going into extremely high leverage, 80, 90% leverage multifamily hotels, assisted living communities, and getting burned. Well, 2013, 14, 15, and today, those same investors from 2008 are still here, and they remember that, and they're more conservative than they were back then. And in about 2014, 15, they're asking Dwight, I don't want to pay any more banks. I want to get done with mortgages. What debt-free options do you have? I don't need to take on a loan. I don't want a loan. But in the DST community, almost all the properties had loans, except for very few. So Dwight K started partnering with different sponsors, creating debt-free products, and he co-sponsored deals. So that was really some of the first experiences that DST's investors had to debt-free DSTs. Well, the demand was huge. Okay, there were more people wanting to get into debt-free assets than were available. So over time, Dwight took on a new partner, Shay Lappin, who's now our president, that said, we need to start an entity that focuses almost exclusively on debt-free DSTs. And then was the genesis of Cove Capital. And they wanted to specialize in debt-free DSTs for the following reasons. Number one, no refinancing risk. Okay, so there's some investment vehicles out there that like private REITs and so forth that have been really talking about the benefits of laddering refinancing, meaning that loans are coming due in a certain time and then they're going to refinance. Many of these institutional grade real estate loans are CMBS loans, meaning commercial banks. And they typically have balloons on them, usually at year 10, meaning the entire loan is due. And so they want to stagger those so that it's due at different times and then they can refinance them. The problem is we got into situations where we're financing at very low interest rates. That's great. But then as they come due and they refinance, well, we're going to be refinancing at much higher interest rates. So that cash flow that those investors were enjoying is now going to be reduced because a lot of them are going from 2.5% to 6% interest rates. And that's really going to reduce cash flow once that refinancing occurs. Okay. Now in DSTs, that introduces an additional problem because in DSTs, you cannot refinance a loan. So that's one of the rules. So if you're in an asset that's struggling and in a typical entity, or if you own the property on your own, you could refinance to help yourself out with your cash flow situation. Well, that's not allowed in a DST. So you have to dip into the reserves and hopefully you have enough reserves to manage that. If you're in a debt-free DST, then you don't have to worry about that debt expense, right? It's not something you have to worry about. Pretty much if you're debt-free, you can handle almost any economic situation and maintain the flexibility to make it out. You still have cash flow risk. You might not receive cash flow for a while, but you're not going to lose the asset to foreclosure. So number two, it eliminates the risk of taking on equal or greater debt in future 1031 exchanges. Okay, so remember when we said that when you do a 1031 exchange, you have to buy property of equal or greater value, where many people, they'll sell their property for $500,000, and then they'll want to go buy a triple net property. And so their triple net broker will say, hey, go out, let's go buy a triple net. Really, to get a decent triple net, you need to pay at least $2 million. So let's leverage up to 1.5 million and then buy yourself a decent Dollar General or something. Well, if you go to sell that property, you have to, let's say there's no appreciation or loss, you just sell it for 2 million. You have to go buy yourself a $2 million property again. And you're going to have to go take on another loan. And if interest rates have gone up, well, you're probably going to take a pretty big cash flow hit, because maybe you got that Dollar General for 3%. You sell it, you're going to go 1031 exchange into an equal or greater value property, take on a loan again, and this loan's going to be at 6% or more. So you may have been enjoying a 9% cash flow. Now you're going to enjoy a 4% cash flow. Okay. So just some things to consider. All right. Number 3. Oh, and also, I mean, if you just want to go more conservative in the future, you know, you're maybe in 10 years, you were 60, still managing your property, willing to take on some risk. Now you're 70. You want to go into strictly asset preservation mode. Well, you've got that debt now. So it takes away options from you. Number 3, debt-free provides 1031 investors the ability to diversify a portion of their exchange dollars into all cash debt-free property in an effort to reduce potential risk. Okay, that probably should have been that should have been the title or something. That's not a good, anyways. So you already know that, but I'm going to jump over from that one to actually like number 5 and number 6, because those are some of the risks that go into number 3. Okay. So people don't realize a few things about debt when it comes to this institutional grade real estate, specifically cross collateralization. So many sponsors will go to investors and say, hey, you don't need to diversify into lots of DSTs with lots of sponsors, because we have this DST that has 20 different assets in it. So you're already diversified all over the country. Well, what they don't tell you is all those assets have a loan on them. And that loan is cross collateralized, which means that if a portion of your portfolio is struggling, then the bank is going to sweep the revenue from the rest of your portfolio and put it in a lockbox and lock it down so you can't touch it. Even though you're still paying income tax on that, you cannot touch that cash. And the bank is doing that to protect themselves, because if those tenants foreclose, the properties aren't going to be worth as much as when they had long-term leases with big tenants. So the bank is going to take the properties, and they're going to take that cash flow that they were holding on to for over however long they were holding on to that cash flow, and you may never see it again. Or if the portfolio does recover, then they'll release the cash flow back to the investors. So that's cross collateralization. Be careful of that. But that cash flow sweep, look at number 6 there. That's what I'm talking about. So not only does that happen when portfolio assets fall under a certain debt service coverage ratio. Oh, debt service coverage ratio. I should say what that means. That's your net operating income. How many times your net operating income, so that's really the revenue on the property, pays down your debt expense. How many times can your net income pay down your debt expense? Okay. And usually we want it to be at least 2 times over. Now, if that drops down to a certain level, then the bank can cash flow sweep. Also, if you have, let's say you have a building to a Dollar General with a Dollar General in it. Now, Dollar General, big credit tenant, they're obligated to pay that lease. However, if they leave, that's called going dark. They're still obligated to pay the lease. But the bank will now cash flow sweep that money, that rent. Even though Dollar General is obligated to pay the lease, the bank is still going to hold on to that cash flow until you re-tenant the building. Not only that, I hate to say it, but you're going to have to go re-tenant that building with someone who the bank approves of. You can't just throw in a Piggly Wiggly into that building. The bank is going to want someone of equal or similar credit. So you have to go find someone with a credit rating like Dollar General to replace that, replace Dollar General to get that money back. If you don't, well, time is ticking and foreclosure risk is a real possibility. So be aware. All right, I'm going to jump back to number 4 now. Flexibility to hold through any potential market downturns, credit crunches, recessions, and/or depressions. Okay, a lot of our clients are very sensitive to number 4 right now, Because like I said, in an inflationary market, debt is awesome, especially when it's as cheap as what we've been seeing over the last few years. But if property values are going down, well, ladies and gentlemen, debt doesn't only amplify your upside, but it also amplifies your downside and introduces foreclosure risk as well. See what else we got on here. Oh, we're still going. We're still going. Let's see. Boom. Sorry, guys. Remember Gremlins getting involved with technology. Here we go. All right, number 7. Oftentimes, all cash debt-free DSTs can have higher projected cash flow than leveraged DSTs. Okay, so this is actually just become super relevant. So oftentimes I would be speaking to investors and then they'd be looking at DSTs because they're looking for a passive option. And they come to me and they say, hey, I'm looking at either this Dollar General over here or a DST. And they say, I've got $500,000, so I could put it in this DST, but I can leverage up with this 3% debt and go buy a Dollar General for 6% cash for 6 at a 6 cap. And I can get a higher cash on cash return. So I'm going to go do that because I want the cash on cash return. And I'm willing to take on the risk of triple net. I'll negotiate with Dollar General to renew that lease. And if they don't pay me that rent, I'll sue them. No big deal. I'll take care of it. I'm still in the game. Okay. Not anymore. So with interest rates going up to 6% and those cap rates going down to 5%, 4%, 3%, well, you have that inverted arbitrage or negative arbitrage where the interest rates are sometimes double what the cap rates are. That means the more debt you take on, the lower your cash on cash return of your investment is going to be. So we are now seeing in the last 2 months that actually debt-free properties are producing our investors higher cash flow than ones with debt. Number 8. Debt-free allows investors to protect themselves from the financial catastrophe of a complete loss of their principal due to a lender foreclosure. Pretty obvious, okay? Especially with balloon loans, what you see in number 9 here. So a lot of these loans, they balloon at year 10. So what that means is a lot of these loans have like 30-year amortization schedules, but are due at year 10. Or they might be interest only for 5 years, then amortized for 5 years, then it's due at year 10. Or it may be interest only throughout the 10-year time frame. Either way, something you need to be aware of, that there's that balloon loan that's coming due, okay? And if you're in a net lease property, here's something important. So listen up to this, especially if you're interested in net lease on your own, or even in a DST, it's the same thing. If you have a balloon maturity on your loan at year 10 and your lease is up at around there, I guarantee you, if you have a smart tenant and if you have a strong tenant, like any of the credit-worthy tenants that your people look for, FedExes, 7-Elevens, Dollar Generals, whatever, they have an in-house team that's checking to see if there's a loan on that building and what kind it is and who the landlord is. And they're going to go to negotiate with you. And if they know you have a loan that's coming due, well, that puts them in a very strong negotiating position because they know that if they leave, you have to go re-tenant that building or your back is up against the wall with a ticking time bomb in that bank that's probably going to foreclose on you if you don't find that new tenant in time. And it's hard to find a tenant that's as strong as Walmart or Dollar General and FedEx. So just something to be aware of there. Number 10, no lender prepayment penalties, defeasance costs, and or yield maintenance. So this is also an important one here. So there's been times, even in DSTs, where I've seen unsolicited buyers come along, especially over the last 5 years, and offer a stupid price for our buildings, right? They're like, hey, it's been 1 year since you bought this. I'm going to offer you $1.30 on the dollar for this building. Sweet, let's get the paperwork going. Well, the problem is the bank has enormous fees oftentimes to pay that loan off early. Now, those prepayment penalties, defeasance costs, and yield maintenance on that loan, they typically burn off over 3 to 4 years. But before then, you're going to have to pay off a pretty hefty consequence to the bank and that could really eat into your profits, and it really inhibits the flexibility of the liquidation strategy on your asset. All right, so that's really mostly what I wanted to cover when it comes to debt and why to go debt free. So remember, debt's not all bad. That's really how people get rich, but it's not the best strategy if you want to stay rich. That's really the moral of this story, okay? And really, here are some of the things that we went over just to keep in mind. Write these down. All right, so balloon loans, right? You don't want your back against the wall when those loans come due. And if you don't want to be in a recession when those loans come due, you know, real estate doesn't always go up. There's recessions. It could go down for a time. It may come up eventually. It always has so far. But if you have a balloon loan that's coming due, well, you can get caught with your pants down, so to speak. All right. Second, 1031 risk, right? Purchasing property of equal or greater value. If you're debt free, you're taking on debt to buy more property. Well, you're typically going to have to stay in a mortgage from then on out. So you may be willing to do it now, but think of your future self. Is your 70-year-old self going to want to have debt to replace? No, just think about that. Foreclosure risk, that's kind of an easy one. Then also the debt nuances, right? So cross collateralization, yield maintenance, defeasance, prepayment penalties, things like that, cash flow sweeps, right? Those are all things that you need to keep in mind when considering taking on debt or staying debt free. All right, so Cove Capital is sponsoring this webinar. So a little bit about Cove Capital. All right, so 1.3 million square feet of real estate managed, 74 properties in the Cove portfolio. And you can see over here the number of properties that they have in the different regions. Okay, so they have national reach there. Little options for everyone. So remember when I was talking about credit tenants for the net leases? These are some of those tenants, right? Amazon, FedEx, Frito-Lay's, which I think is Pepsi, DaVita, Dollar General, Tractor Supply, AutoZone. Those are all big tenants with that usually equate to very strong leases. All right, so just little things about Cove Capital. So think a little bit about Cove Capital. They mostly specialize in DSTs for 1031 exchanges, but you can invest cash. Usually the minimums for cash investments are $25,000. They also have some funds that are debt-free, net lease funds, as well as multifamily funds, all debt-free. Those have a little lower minimums and with potential for higher upside as well and higher income. So feel free to give us a call to ask about those. And also, many of you have probably heard of the 721 UPREIT. So Cove Capital is currently working on syndicating a very large debt-free REIT at this time. So when you call in, be sure to ask about that because they're going to be offering the opportunity to potentially 721 UPREIT so basically sell your ownership, your shares in the DST for operating units in their REIT, and therefore deferring your taxes and staying debt-free. So if you're interested in that, please feel free to give us a call and let's discuss whether it's a suitable option for you and your family. And here are just some assets, right, that they've had in the past that are debt-free. We have an Amazon distribution center, and these are not currently available. These are past, so I'm not selling these. FedEx in Rochester, a Tractor Supply outside Nashville. This is, let's see, skip these. These are live, so I got to skip those. All right. So I think with that, probably open up everything for, open up the questions at this time.
Yes, thank you so much for all that information. I did put up a poll question if any of you want to schedule a consultation. If you say yes, I'll connect you over with Steve after the webinar just to make it a little easier. And I do see some questions that came in. The first one was from Richard. He's asking, once you sell and buy a property in a 1031 exchange, at what time can you use it as a second home or move in for a period of time?
Good. So that is a good question. So you have to ask your CPA and your tax attorney because I cannot give tax advice. However, what I typically hear from the, at least in California State Franchise Tax Board, is they like to see 2 tax returns under your belt before you make that conversion. That's just what I've heard pretty regularly. I'm not telling you that's what the answer is, but so please speak with your CPA, but ask them about that number.
Great. And from Aaron, what happens in a 1031 exchange purchase that we went under contract within the 45 days, but then the seller pulls out of the property?
Yeah, that's tough. So that's a real risk that you're running into with closing risk when doing a 1031 exchange. So what we do is we like to have consultations with our investors. And if they decide that a DST is not right for them, totally fine. We do not want to pressure you into doing something that you're not comfortable with or not ready for. Some people are better off owning their own real estate. But what I think we could partner with you on is providing you with a backup option. So by providing yourself with a backup option, a readily available like a DST, you have stronger negotiating power when you go to the table with a potential seller. So if they back out, say, fine, I'm going to go back into this DST that's ready for me, and I have a reservation waiting for me for $1 million of equity or whatever it is that you're replacing. Also, if you have say $1 million sale and you're buying a property for $900,000, you have a little bit of equity left over, well, you can throw that into a DST as well. You don't have to pay Uncle Sam that $40,000 on that $100,000 boot. You can just place that in a DST. And so we have options for that as well.
Nice. So from Wes asking, can you talk about the liquidity of Cove Capital's DSTs? If an investor wants to get out of a DST, what is involved?
Good question, man. These are good questions today. So these are commonly considered non-liquid investments because there's no secondary market for them. There's no New York Stock Exchange or anything like that. Okay, so you can't trade them with a click of a button. However, we have thousands of people on our platform. I think we're pretty commonly considered as the largest in our industry that specialize in DSTs, and this is Cove Properties specifically. So I may have done the most secondary transactions out of everyone in the industry, which is probably about 7 or 8. So it doesn't happen very much at all. But we could find another buyer, and it basically looks very similar to a real estate transaction. We send out letters to current investors in the DST that you're in. We send letters out to our platform. We find potential buyers, and then we land on a price that you're comfortable with, set up an escrow, and do the transaction.
Well, that's great that you guys offer that service if necessary. Well, Wes is also asking, what are the typical rates of return?
Well, you've got varying levels of return based on the asset and the strategy. So your rates of return depend on a few things, right? There's your cash flow, your cash on cash return. There's appreciation on the back end. And then if you're talking about IRR, for example, you have to consider your tax sheltering. You have to consider and your amortization on your loan and building up of equity if there's a loan on the deal. But overall, I would say maybe have the expectation of cash flow being between 3.5% to 6% cash on cash return. And then I would just say national averages of the asset. So if it's a multifamily, say 2% per year. And if it's a net lease property, maybe 1%. You know, it's net lease or kind of bonds. You know, I don't give my investors very high expectations for appreciation there. But that being said, if you saw some of the returns that we're getting recently, I mean, they're blowing those numbers out of the park. I just want to be more conservative going forward, and keep in mind you could lose money. So it might not meet those expectations either.
All right. And Joyce asking, what happens when a DST I am invested in closes?
So when a property is getting ready to liquidate, they're going to reach out to you, provide you well ahead of time. Usually when they're just anticipating on selling the asset, they're going to talk about who the broker is that they're in negotiations with, who they're going to award the listing to. when they're doing their best and finals with potential buyers, who they're entering in escrow with, what are the terms of the escrow when contingencies are lifted. So you're being updated throughout the entire process, and we are too, as your broker and advisor. So we'll be working with you hand in hand throughout the entire process to find you a replacement property. And if you decide you don't want to go back into DSTs, or you want to do a hybrid of DSTs in your own property, then we'll help you with that as well. And maybe you want to pay taxes on a bit, buy your own property and do a little bit into DSTs. You can do a hybrid of all three, or just do one of them, and we'll assist you through the entire process.
Nice. Joyce is asking, is there any point in selling my building in a 1031 exchange and then into a DST that I will have tax consequences?
Is there any point in selling a building and then going into a DST and having tax consequences? I might not have heard you very
Yeah,
well.
that is the question. I think if I'm understanding this correctly, she's just asking, is there any point at all, if you're doing a DST from a 1031 exchange, that you'd ever have to pay taxes?
If you follow all of the 1031 guidelines and you're in lockstep with your CPA, making sure you're buying property of equal or greater value, and the DST performs as planned, you should be able to continue to defer your tax consequence. And then, as the law currently states, until Congress takes it away, when the owner of the DST passes, just like when they own their own real estate, the heirs get a step up in basis. And then how the assets bequeathed to the heirs is dictated by the will within a trust, typically, if it's held in a trust or however it's held. So I hope that answers the question.
Yeah, she said she'll reach out to you after the webinar and follow up with that with some more clarification.
Okay, great.
Yeah, Elizabeth asking, what are the fees? Yeah,
so there's, I'd like to say there's 3 levels of fees that are in DSTs. One is the real estate fees. So that's what you would theoretically pay on your own, okay, to do due diligence, escrow, mortgage points, whatever, to take down the property. So the sponsor is going to buy the property at a certain price, and then they're going to have their fees to buy that property, just like if you were going to go buy the property. And then they're going to pay me and my company. So that's another layer on top of that, as well as marketing on top of that. Then they're going to have their acquisition fee. It's usually 1 or 2%. That's how they make money. Okay, is that 1 or 2%? And then some fees that go to the syndication, like broker dealers and things like that. So basically, it's real estate fees. Then there's the sponsor, their acquisition fees, and then there's the syndication fees that you typically wouldn't pay if you were buying it on your own. But hopefully the sponsor is able to eat into that on the front load by buying the property below market value, because, well, frankly, they're not going on LoopNet or Corexi to buy these properties like you and I would. Typically, by the time you and I would have access to these deals, they've already been rejected by 100 different institutions. So they have broker networks that are feeding them off market deals. And so hopefully that eats into the cost of that. But there's probably, if they're getting if they're advertising a 5% cash on cash return, all things held equal, if you were going to go buy that asset, you might get it at 5.25 or maybe 5.5 cash on cash return. And so basically you have to decide how much is it worth to you to go manage your own real estate and go completely passive and be able to diversify and then access this quality of real estate. So that's really the trade-off for that, maybe 25 basis points to 50 basis points of difference.
Yeah, and that certainly could be worth it for a lot of you on the call that don't want to manage it so closely. So with, let's see here. Lorena, if I sell to a DST investor, do I pay a commission? I think maybe she means if she's in a DST and is trying to get out of it and sells her piece.
Yeah. So I don't really recommend planning to do a secondary transaction, because traditionally you're not going to make as much money as if you waited for the property to sell. And one of those reasons is, you do pay commissions. Now I have waived commissions before because I had a client that was in a desperate situation, needed to sell tomorrow. So she was taking a discount and I was like, you know what, I'm just going to waive it to get her the money because she really needs it. But historically speaking, it takes a lot of work to find a buyer. It takes a lot of work to drop a unique paperwork for that situation, set up escrow. So you're going to pay some commission on that. And you're also going to pay about $1,000 or so in escrow if you want to set up an escrow. So at least that's what our escrow does for us. So those are all things that you're going to have to take into consideration if you're going to do a secondary transaction.
Yeah. And I think that goes back to what you were saying about it just not being meant to be a liquid sort of investment, right? As some other things could be. Elizabeth, on that note, is asking typically how long is a DST held?
5-7 years is what we've seen on average. I think the average we've been involved with something like 25 billion in DST property by now. And I think it's averaged like 5.73 years or something like that. We've had a hot real estate market. So we've had a lot of deals turn over in like 3 to 4 years. I don't think that's going to be the norm in the next cycle. So I tell my clients, if there's not a 721 UPREIT built into the DST, then plan on holding it around 7 to 8 years.
Okay, well, that answered a few repeat questions there.
Good.
If an owner passes, then can heirs can they get out? If the owner of the DST passes.
So it would be a secondary transaction. So the heirs can get out. And when you do that, you can do a 1031 out. But most people don't because there's a step up in basis. So they just get out. But keep in mind, there's probably, depending on how fast you want to get out of that DST, you might be paying a discount.
Okay. And I think you already answered this, which is if the DSTs close or, sell, whatever you want to call it, then do you have to go into another DST? And you mentioned you could split it up into a few different ways, right? You could go back into properties, you could do a different DST, combination of both.
You got it.
Okay. And let's see. Richard asking, can you sell a property and use the proceeds to go into 2 properties? That would be like a traditional 1031 exchange, I believe.
Yep. The only rule is you have to purchase property of equal or greater value. Make sure you're in lockstep with your qualified intermediary and your CPA. There's typically 2 rules that most people use. One's a 3 property rule and the other's the 200% rule. So yeah, we can either talk afterwards about the nuances of those 1031 exchange rules, or I'm sure your qualified intermediary will be happy to walk you through it as well.
Okay. Glenn asking, have you ever not been able to close a 1031 exchange purchase? Like what happens after the 45 days if you don't?
People do it all the time. Not in DSTs. I've never experienced that in DSTs because when that 45-day window is up, man, that's the most important day of the year. And DSTs, they're easy to close on as long as you're paying attention. But I have had people that were going and buying their own property and they couldn't find something. And I have had folks that given me a call and they said, hey, I can't find anything in my 45th day expired. What can you do for me? I said, well, nothing. We've got cash investment opportunities if you're interested in those.
Yeah. Okay. Well, that's a realistic possibility. Elizabeth asking, and I don't know if that I understand this question, Elizabeth, maybe you might want to clarify. Do we go into a DST as a group when it's new? So I think she means like all of them at once, right?
Yep. Yeah. So she's referencing the old tick days. So when with tenants in common, when folks would a sponsor would line up all the investors that are pledging a certain amount of money to that tenant in common, they all identify it. And they're praying that that sponsor can raise enough money to close on that property so they don't all blow their 1031 exchange, which is a real risk. In DSTs, it's not a risk because the sponsor has already closed on that property. So it's already done. It's already available. And then they've closed on it and they're just peeling off shares and selling them to different investors. And what we do is we make reservations before you're closed. So you say, hey, Steve, I want $100,000 of Cove net lease 55. And I say, okay, I'll go make a reservation. So I call the sponsor or email them and I say, Mr. and Mrs. Investor wants $100,000 in Cove 55. Please set it aside. They're closing next week. And so then they've set it aside. We get paperwork going, and then you close on your property. The money is just transfers to QI, then goes right to the sponsor, and we close on the DST the next day.
Nice. That just sounds simple. Okay. Also, let's see. Well, this one's kind of a little more specific, might be more tax advice. Parvi's asking about what the capital gain tax would be if you sell a vacant land in Arizona and buy a condo in California, and it's, you know, 500,000. So that's probably a question for your accountant, I would think. Or do you think this is something Cove or Kay could probably answer for them?
Well, maybe the answer is nothing, because you don't pay any taxes. You're deferring it because that's like-kind property. So, so say your Arizona property is appreciated, you sell it, go find a multifamily property in California. As long as that multifamily property is equal in price or greater, you don't have any tax consequence there, or at least you defer it.
Right.
So,
with a 1031 exchange, right?
Yeah. So unless if that doesn't answer, then maybe we can chat after. Maybe it's a question for your CPA.
Yeah, yeah. And it does, you know, bring up the point again that you can transfer into any type of real estate. So land to condo, land to apartment building, or commercial, all of those would be, you know, like kind. All right. So that, I think, resumes the question. Well, there's one more. Let's see. Yes, Elizabeth. Okay. And I think we have answered all the questions, which is fantastic.
Right on time. Hey.
Good job. Wow. Look at that. So with that being said, I'm going to email everyone the recording tomorrow. You'll also get Steve's info, Cove's info, if you do want to set anything up. If you did already say that you want a consult, then don't worry about it. I'll just connect you guys so you can move forward from there. And any questions that come up, let me know. I can forward them along to Steve as well. So thanks, Steve, so much for your time.
Yeah, thank you, Alexandra.
Yeah, and getting all those questions answered. That's great.
Yeah, beautiful. Love partnering up with you guys. Apartment Association is a fantastic organization.
Thank you. Thank you. Yeah, we enjoy having you too. All right, everyone. Well, until next time, have a great day. Bye.